Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We are bringing the VRIC to you each and every week with our series of expert online panels. I'm very excited for the one we have lined up for you today. It's Trader Ferg of the Trader Ferg Substack and Andy Hoese of the Finding Value Finance YouTube channel. Gentlemen, it's great to have you both on the show today.
Thank you for having me, Jesse. Great to be here.
Yeah, thanks for having me, Jesse. Appreciate it.
Yeah, great to have you both on. I love both of your work, so it's awesome to bring you together for this episode. We're going to be talking about unloved sectors. We're going to be talking about a variety of commodities. So I'm excited to dive into things. I want to start with a broad question first and ask you both, what are the main areas in the market you are looking for value in right now? And Ferg, I'll start with you.
Yeah, so with me it's oil. Yeah. I just sent a post out yesterday. Called it the pain trade because I've been all over oil services, and more recently I just can't take my eyes off the implied volatility on just straight plain oil. But in particularly the futures, it's the lowest in a decade now. And that just gives you tremendous upside if we get any volatility, and we've got the market in backwardation. So just gives you a huge amount of torque um, if the view that I have moving forward plays out. And so that's what I'm kind of obsessed with at the moment. And it's interesting, when I sent the post out, it was just before my friend Paulo Macro, he sent his piece out, and it was along the same lines. So I always love when yeah, kind of, we hadn't talked about it, but we've kind of seen the same thing in the market. So it's when you can get cheap volatility, you don't have to be that right either. Like, I could be right for a whole lot of silly reasons. Someone could fire a missile at someone could invade someone could, whether it's demand side, whether it's supply side, whether it's, I don't know what the reason will be. I've got my suspicions. I've poured a lot of digital ink on what the reasons will be, but probably won't be for them. And yeah, I love that trade at the moment. And granted, I've lost a decent amount of money on it to date. I've just been burning premium, and that's why I kind of try and cap my exposure to options and spend most of my time just hunting for small cap service companies in the space that are generally well-run little businesses that are just hated and forgotten, super cyclical, and I think they're going to have their day in the sun for the next few years. And I'm trying to find them before they break out of these long-term bottoming patterns.
Very interesting observations there. You're preaching to the choir. The majority of my portfolios in energy. I had John Polemy and Josh Young on the VRIC channel last week, where we talked all about the oil and gas sector. Josh was saying that he's seeing more opportunity in the small caps, as you brought up. Do you think there's still, just as a follow-up, do you think there's still opportunity in the medium to larger cap producers still at this moment, or would you focus on the services sector, as you mentioned, on the smaller players in the game? And are there any other areas? Oil tankers, I know, is something you've spoken about in the past. Is there still opportunity in that sector as well?
Ooh, it really comes down to your circle of competence. So I'm not that smart when it comes to a lot of the sort of corners of commodity markets. Like, a geologist could sit opposite me and tell me an amazing story about some mine, and I wouldn't be able to call his bluff. Same with someone that's sitting opposite, like a whole lot of wells, or like could tell me all these flow rates. I just nod my head and smile, and I don't know if they're like a good one is Pantheon Resources. I just heard for years like bulls and bears like telling their side of the story, and I couldn't tell heads or tails of it. So I generally put producers outside of my circle of competence and just stick with stuff I can work out. Like, I can work out how much OSV, what the replacement cost of it, and what it's trading today. If I can get in a big replacement cost, then I'll be all over that. I just want to keep it as simple as possible. So I stop myself from doing dumb stuff, which I still manage to do pretty regularly anyway. So a lot of my style is just trying to whether it's going after restructured, where kind of call it getting subsidized by the prior shareholders, like they've lost all their money, they've had the debt wiped out, the senior debt holders become the new equity holders. They really want to see the company succeed. And when you go in alongside them, I think your odds go up a lot. And so, yeah, I'm just trying to make it as simple as possible for myself. And so that's generally why I've avoided producers. Granted, the people are far smarter than me and have done really well out of producers. And yeah, I've got nothing against it. I just find it a little bit tricky, and nothing annoys me more than losing money when the sector goes where I thought it would, and I just stuffed it up because I was trying to be too smart and thought I could understand something that I couldn't understand. So that's why I generally steer clear of producers.
Quick break here, guys. Today's episode is brought to you by Copernico Metals. Now, regular viewers of my channel will be familiar with the entrepreneur behind Copernico. His name is Ivan Bebek. Now, although a young man in this business, Ivan's already created tremendous value for his shareholders in the past, namely with Caden Resources, which he sold to Agnico Eagle, and Keegan Resources, which became a mine now owned by Galliano Gold. Now, Ivan has surrounded himself with expertise from BHP, Newmont, and VRIC on his board at Copernico Metals. Check out copernicometals.com. Now back to the interview.
That's great. I love to hear that. Following the circle of competence. That's also great advice for anyone listening, because there's so many, when we talk about the commodity space, there's so many bull theses out there that it's easy to get wrapped up in them all. There's going to be a copper shortage, uranium's going to go to this and that and the other, and you end up investing in everything. And that could be a dangerous combination. Andy, maybe to follow up on what Ferg was saying on the oil side of things, are you also seeing opportunity there, and anywhere else where you're currently looking for value in the markets?
Yeah, I think I break it up into two sectors, two areas, I should say, energy and precious metals. Those are the two that I really like. Energy, incredibly cheap. You can price it against other assets, like an oil to gold ratio. We're above 30. That's really, really cheap historically. It's an objective way to see if something's cheap or expensive to use ratios. So that looks really good. I think the charts look pretty good too in terms of oil producers, energy service companies. I think they're cheap when you do like a free cash flow to enterprise value, like anything that you basically can price these things under, they're pretty cheap on the cheap end. So we look at commodity to stock ratio, that's also cheap. So when I look at all of this and I try to figure out, where to put money and invest it, oil, energy service, precious metals, they kind of bubble to the top. So that's kind of where I put my focus on. And that's where I put the majority of my investments in, is where's the best opportunity with the most asymmetry. Asymmetry will carry the portfolio. That's huge upside potential, low downside risk. And if I'm wrong on one or small little section of it, the symmetry will carry the portfolio higher. So I think those two areas are going to do really well, given the market conditions that I think are coming, which is a more inflationary period and higher interest rates, just over a longer period of time.
Well, I do want to dive into gold and silver mining specifically a little later. Ferg, did you have something to follow up with there?
No, I think Andy's spot on there. I was just, as Andy was saying, that there's the chart I just put in my last presentation that both they're like inflation expectations moving forward are like the lowest they've been in the last few years. They're like near zero probability. And so I always find it fascinating when and it's also hand in hand with recession probability as well. And for anyone that's been following like the headlines, it was 2 years ago, Bloomberg had 100% probability of a recession, and now the probability of recession is essentially zero. So I always find it fascinating when there's any certainty in the market, because it's when there's certainty that nothing's going to happen, that's where my ears really prick up, and I start really trying to take the other side of that. It was one of the first books my mentor gave me, was this one by Humphrey B. Neal, and it was The Art of Quantitative Thinking. And it was just the study of history, that every time consensus decides that something is absolutely certain, and it's a new trend. Historically, it never played out. It always the consensus was always wrong, and so I just that always stuck with me, and I always look for these areas where you can take the other side of consensus, and if you can get like a great payoff, like just what I was talking about before with the playing it via options, you've just got so many factors working for you. You've got the implied volatility, which just has a huge impact when you go out of money in options. That's just a real multiplier. You've got backwardation, which for those that don't know, it's like versus the price today, you're getting oil cheaper out in the future, which is just adds to the torque that you get with options. I think WTI, it's like $10 cheaper if you go out to December 26. You've got a whole lot of assumptions going into whether it's shale that I've gone through, whether it's the demand side of things, like the IEA for saying that demand's going to be quite weak moving forward, and then you can look at their historic accuracy of forecasting demand. And I've got this chart that I love from Rosenzweig that shows that they've got it wrong year after year by roughly 1 million barrels for like a decade. It's the most crazy chart that you could get something that wrong. Only in sort of a government, quasi-government agency could get something wrong for 12 years and no one get fired. They show the chart and then say if it was, I believe the quote was, if you tallied up all their errors, it would be like the 8th largest oil producing nation in the world.
Yeah, I mean, the IEA is not even worth listening to at this point. They're completely captured by political ideology. It's bizarre that anybody listens to anything they have to say at this point in time. But I want to move on to where investors can find these unloved sectors where the rest of the market isn't looking. Ferg, I want to read a quote from your newsletter and then get both of your thoughts. You said a large part of this game is finding areas of the market where you can get a great payoff in expressing your particular view. This is where searching out hated sectors comes into play. If the consensus is that the sector is in terminal decline, then the payoff should be substantial. How do you both go about finding these sectors that are unloved and that the market in general isn't paying attention to? And Andy, I'll start with you on this one.
Yeah. So I call it the 3 pillars. I use technical analysis, ratios, and market conditions. Market conditions align with cycles. So when I look for something that is hated, I should be able to objectively quantify that it's cheap in relationship to history. So that's where the ratios come into play. They kind of tell me if I price oil to gold, if I price oil in terms of the S&P 500 or financial assets, I can clearly see objectively that we are cheap compared to history. Then I can do further digging. Do the technicals on the charts look like they've been in a downtrend or bottoming? Kind of bottoming out, we call it stage 1 if you do stage analysis and technical analysis. So is it in a stage 1? Are we breaking out of stage 1 into stage 2? Those are the things that I look at. And if we get an alignment, cheap ratio, a good bottom technically, and we're in a good portion of the cycle where we're going to start coming up where financial conditions will be conducive for the turn of the sector. Think of it as credit coming into the system, like we're coming into an inflationary period. Then everything kind of turns on and says, yep, this is a good time to buy it. It's cheap. And it's time to take entry points given the technicals are good. That we look for that alignment. So that's kind of what I look for. And I say that's what I teach on the website. So we all look for that for hated sectors that are inflecting into something that's positive. One of the major things that you also want to look for is asymmetry. That's probably one of the most important things to look for. And I think that's probably what Ferg was talking about there. Asymmetry is where you get these big payouts and you have your position size could be what limits you for your downside risk. That will carry the portfolio on up. And I don't know of another way in the market to make money outside of what I just described. You basically have to take a opinion that's opposite of the consensus or opposite of what the herd is thinking, which is very difficult to do. A lot of people, their entire life, try to fit within the herd. They try to fit within society. They try to fit within, basically becoming part of the team, or so to speak. And this is exactly opposite. So you have to run away from where everyone else is at. So that's another thing that you can look at, is what are people talking about? What is consensus? What is the sentiment? And if the sentiment is good and people are talking about it, perhaps NVIDIA and technology stocks right now, that's probably what I would consider to be what's consensus at the moment. That's where you want to run away. That's where you have the largest amount of risk and the potential to lose money. So that's kind of how I view it. It's sentiment, cheap ratios, good technicals, and where are we at in the cycle.
Great thoughts, Ferg. How do you go about determining if a sector, because as Andy was touching on there, I think it's one thing for a sector to be unloved or hated. It's another for there to actually be a thesis to invest. So how do you marry those two things together when you're looking at a sector?
Yeah, so I start with charts. I'm not that technically based, but I think Andy and I, when we've chatted before, like I think the joke was like you want like there to be a heartbeat and then you want the patient to essentially die. Like you want that flat line for a few years and then you want almost the heartbeat to start. And ideally you buy the thing before the heart gets restarted, or like there's a slight breakout. And so that's where my process starts, is I'm looking at these dead patients and like what's going to bring them back to life, and that's when I'm probably a bit more fundamentally driven. So I like want to dig in, and really I like doing like kind of deep research on the sector, not so much on the company. I don't think I'm a great analyst of companies. I see far smarter people like digging through balance sheets and finding angles to make like a set amount on when this gets the company hits this event or something. I'm more like trying to work out where the sector, like a recent example was Platinum Group Metals. Like I just saw them get absolutely punished. The companies, everyone's decided that there's no demand moving forward because EVs no longer require catalytic converters, and so the market's going to be in terminal decline for the foreseeable future. And then the sector itself is kind of an interesting setup where you've got a lot of the Russian supplies of byproducts, so it's negative cost. You've got this gap where almost no one produces, and then you've got a whole lot of high cost producers in South Africa. And so the whole sector's sort of having the brakes put on it because the cost's gone below a third of the sector can't produce a profit. And so that's when I get really interested. I was like, is what the market's kind of forecasting, is it correct moving forward? And then you kind of dig through the supply story, dig through the demand. And what I came up with is I think the market's completely wrong. I think the demand's going to keep surprising to the upside, largely because hybrids are going to surprise and continue to surprise moving forward. They're going to be the ultimate winner, not pure EVs, and they actually require more platinum group metals. So that's a sort of example of mine, just seeing a beaten up chart. Granted, platinum group metal wasn't the perfect chart. More perfect chart would be something like some of the small oil service companies, if anyone's wanting like an example, like a sort of a Mermaid Maritime, that chart where it's just literally pretty much died, going along flat, barely moving, and then suddenly OSVs start correcting, day rates start rising, and cash flow starts flowing to the bottom of the line again, and then the stock starts to get re-rated very quickly. And I love trying to spot those just as they start to inflect. Often I do it via the relisting or after a quasi sort of a Chapter 11, whether it's a pure bankruptcy and restructuring, or whether it's just a really heavy recap, sort of decide if the company's in a good position moving forward. And yeah, just do a lot of research on the sector, because there is a lot of these charts that don't go where you can buy something that's dead. It's proper dead. It's like, yeah, you're not going to have a thesis about like fax machines coming back or something like that. That's a dead chart for a reason. It's like, yeah, you don't want to sit in the value trap. And another way I like to think about this is just like there's like I've kind of termed it like inflated demand, like knowable demand, or inconvenient demand. Well, and I see a lot of stuff, whether it's battery metals, granted not so much now, that I kind of called like inflated demand. I just didn't think the demand was ever going to live up to the forecast or the extrapolations. Then there was like knowable demand, which is why I was so bullish on the likes of uranium, because I kind of thought I could work it out. Just number of reactors, number under construction, work that out versus supply. And it's one of the few sectors where demand was actually something that some guy sitting in his house in his undies could sit on a spreadsheet and work out. And so that was hugely appealing. And then the inconvenient demand was one that I found really interesting, is just coal. Like, it is fascinating when you could, if you just dug in the weeds and see what China and India are actually doing, how much they're building, understand the magnitude of it. A lot of that stuff was not getting reported, and so you could see. And even today, I think it was last week, I read the BP energy review outlook, whatever it is, and they're still, their current trajectory for coal is it's about to roll over, and they've revised that current trajectory every year after year, and it just keeps being wrong, and it will be, because China has under construction and permitted 23% on its current coal base, and planned up to 33%. And to put that in context, that the rest of the world, and by excluding India, China's going to add. And India, who was supposedly going to add a lot of renewables, has now backtracked on that, and they're going to add 25% to their coal base, and they're going to do it by 2030. So both of them are just building coal plants like crazy, and there hasn't been that much reporting of it. Everyone's sort of, it's just too inconvenient. It just makes a mockery of the whole net zero. So yeah, long-winded way to answer your question. Sorry.
No, great thoughts there as well. You mentioned uranium. I do want to touch on the uranium sector, a sector that both of you have discussed before in great detail. Ferg, last time I had you on, you mentioned that you thought the train had kind of left the station there. We have seen a pullback in the spot price as well as the equities since then, since it kind of reached a fever pitch. It is one of the most pumped sectors on social media, I find. These days, everybody into uranium on Twitter is just into it regardless. It just seems like it's almost like a true faith. It's a true belief. It's almost a religion at this point. I wonder what you're both currently seeing when it comes to the uranium sector. At this point in time, could this be a good entry point, seeing as some of the equities have backed off? Or do you think the majority of the gains have been made at this point? Andy, I'll start with you.
Yeah, so I think uranium's a good sector. I think the price of uranium can still go higher at positive technicals over the long term. We're in a short-term correction, but the question that I always ask myself when I'm an investor is, how does the company translate that higher price into cash for the investors? How, their earnings per share, dividends. Are they doing share buybacks, stuff like that? A lot of the uranium companies, I don't know how they're going to convert a higher price of uranium into earnings or something for the investor. That's the only thing that I see negative about the sector. Is the majority of the sector is very young. They are explorers, developers. I just don't know how they're going to convert it into cash very easily. So you're relying on people to come into the sector, buy those stocks that you own, and push the price higher. So another thing, when I look out into the future, I see artificial intelligence. I see a lot of electricity demand. I see power demand all across the board. I just don't know how that will fit into the uranium thesis for nuclear being developed in the short term. I think in the short term, natural gas and coal are just going to absolutely light it up. And this is going to probably be for the next 10 years. So I know I'm kind of turning this into natural gas and coal, but uranium, I think it's going to be in a squeeze. It's going to be a huge squeeze. Totally agree with that. I just don't know how the companies are going to bank on it. The majority of the companies. I still think the sector will go up. I still think there's a lot of upside potential. I just think that there's opportunities in the market in the shorter term where there are companies that can convert an idea or a situation into cash way more easily than the uranium companies. So that is a part of risk. So as an investor, when you look at risk, you say, well, the question I ask, at least at a minimum, is we've got a situation, it could squeeze. How does that situation and the company turn the situation into cash? If a company has something like infrastructure in place, these energy service companies, they've got all the infrastructure, the ships and all these things already in place. We're just playing a squeeze on rates. Your uranium, you're playing a much riskier game with a lot of the companies because you're playing the squeeze in uranium, and then you're also playing hoping that people buy these companies and then hoping that the company can get financing. It's going to probably dilute, you as an investor to raise money if they're going to raise it that way. So I just see it as a little bit riskier sector. It could easily go up, many, many fold like we've seen in history. And I think the sector itself, supply, demand, all of that is exactly right that people are seeing just like everyone else. Like there's going to be a big squeeze. Another thing to think about is every time we've had a big bull market in uranium, it hasn't been from the supply demand squeeze necessarily. It's been financially driven historically, like in the 70s, in the 2000s. If you look, a lot of those timeframes, commodities all went up together. It wasn't just uranium, it wasn't just oil, it was everything. So when I look at the sectors, a lot of people focus and only focus on supply and demand of each of these sectors or components. But looking historically, it's all been financially driven, in my opinion. So it's the denominator that's driving a lot of this. You've got the numerator, which is uranium, and the denominator is the dollar, is what it's priced in. So if you see a weak dollar, if you see that dollar drop, I think you're going to see commodities, everything go up together. And I think that's when you're going to get your big uranium bull market. And a lot of people don't talk about that. They just talk about the sector. They just talk about the squeeze. And I totally agree with all that. And more money could go into uranium because of those fundamentals of the sector. But I think a lot of people should also focus on the denominator, which is the dollar. And if the dollar is strong or weak, all commodities are just going to rip, I think, at the same time. And I think the catalyst for that to occur is going to be a weakening in the market where maybe we go into a tech bubble or something like that, which I think we're in. They're going to lower interest rates, and I think the dollar is going to drop when they lower those interest rates. We could get a sell-off right in the beginning of it. I think we're kind of going through it right now, where everything's kind of like, it's almost like everything's been weak for the past 6 months, year. We could even go a little bit further to the downside, yank everything down. I call that the slingshot, where they yank everything down, the dollar will drop, and then everything rips after that, which will be the cause will be the weakening of the dollar.
That's some great points about the uranium companies being able to capitalize on a higher uranium price, because there's very few producers that are producing in any sizable quantity right now. There's a lot of hope and a prayer type of situations. I mean, we've seen interesting developments. We've seen Niger, the coup happened there. GovEx gets their mining license pulled. Global Atomic now dealing with issues with financing. We've seen these stocks take a beating. You look to Canada, things take forever to get permitted. So outside of Cameco, what do you got? You got NextGen, who has the greatest undeveloped uranium deposit, who's blowing cash on sponsoring hockey teams and race car drivers and buying uranium at 90 some odd dollars a pound. And then you've got Denison, who's, hopefully they're going to get ISR approved in the basin, but who knows, all these environmental red tape, on and on and on. Ferg, what are your thoughts? Do you think, given all of that, that if somebody was to venture into the uranium space who's maybe not already in there, that the best place to go is to just buy spot and call it a day, or maybe stick to your Cameco's and Kazatomprom?
Well, whenever I talk about it, I just talk about what I've done. So I haven't bought any uranium since 2021, bar one private placement I did maybe a year ago. And so I just start with what have I done with my portfolio, so I'm not misleading anyone. So yeah, I haven't bought uranium for years and years now, and I just have a very clear plan of how I plan to exit it. All my incremental capital most recently has been going into oil services, straight oil calls, platinum group metals, some sort of offshore plays. So yeah, I haven't bought any more uranium for a while, but I am still hanging in there because I do see a lot more upside. I have always said that I'd be willing to head to the exits when I can see supply demand balancing. And currently, by my kind of analysis, there's still a decent, more pushing a quarter gap between where supply needs to be come 2030 and where demand is, and that's pretty conservative on the demand side. I could go a lot higher than that if I wanted, and as I look at my sheet, I'm crossing names up. The supply isn't getting any better. Cross GoVX off. Obviously, Global Atomics going to be pushed back a few years. They just keep getting having issues with the financing. You go through all the guidance that's been provided by all the companies to date, and most of them you can probably knock it back 2 years, and some of them you could probably cross off for another 4 or 5 years. It's just mining. Mining's hard, especially with environmental considerations, cost inflation. The fact that there's no one with uranium mining expertise. Everyone expects these sort of John Borshoff types to just appear out of the woodwork and start bringing these mines. Like a good stat is, if anyone's watched an interview with John Borshoff, he reminds everyone that of, I don't know how many uranium companies promised they'd get into production in the last uranium bull run, without a major or a JV with a major. Only Paladin of all the developers actually got into production, and so that's just huge attrition rate. And so when you look across all these all the current companies, and there's a lot, they honestly got their assets cheap because there was questions over if they can produce. I'm thinking of a few names that their ISRs just constantly cause problems, and they keep promising moving forward and keep failing to deliver. And I see a lot more of that. So I see more upside. I've trimmed very little of my positions, and I want to see that supply demand gap start to close, and then I'll very aggressively trim down my positions, and most likely that capital will find a home in most likely some of the oil service, maybe some of the coal space. But yeah, if I'm saying someone looking at the sector today, I wouldn't be jumping on it. Yeah, I think there's far more asymmetry in oil services and EGMs, and yes, straight oil calls. That's where I'd be. Because yeah, even when you talk spot, it's not the same asymmetric proposition as it is whatever it's trading today in the mid 80s. Last time I looked, that's not the same proposition as was when it was in 20s or 30s. I've got this like kind of idea that I always have a hurdle rate in my portfolio, and this is something that I judge all my investments by. And for a while, physical uranium was my hurdle rate. I was like, if I can't get an easy 3x like I can with physical uranium, why am I even looking at this company or this asset? Like, it's especially with how low the risk was. And so over time, I constantly sort of transition to whatever my new hurdle rate asset is. And so I judge everything in my portfolio, and it helps me take less dumb investments. And yeah, the last part of uranium as well is with the Kazakh side. Like, if you put those numbers into a spreadsheet as well, just to give people an idea with what they with their production of what they thought they could hit with the subsoil use agreements, that in 24 and 25, I think it's almost certain they're going to miss. They're going to have to reduce to 25. That's going to knock out what supposedly the entire development sort of uranium developers could bring on for those 2 years. That removes all of it. And that's before sort of start going through them and saying how many of them are going to miss as well. So yeah, I think where this goes is there has to be massive price appreciation. There has to be a lot of capital flow into the mining sector to capitalize a lot of these developers so that they can get projects across the line. It's quite logical. I don't. Some people that argue spot will do something crazy and the miners won't really perform. And whereas that could happen in the sort of 2005-6, because if you look forward, the market was always in surplus. So you could have a crazy spike and a crash, and it didn't actually matter because the market was in surplus moving forward. We don't have that luxury today. You can't have a spike and a crash and just this at least a quarter sort of gap, probably larger if you start to consider some of the sort of the higher use case scenario, which is just going to keep climbing. You can't have the spike and crash. You have to have uranium brought on, and so that's how I'm viewing it. I see a lot more upside.
Well, let's talk about gold and silver miners for a moment here. Andy, you mentioned the precious metals is something that you're bullish on at the moment. How do you view the gold and silver mining space? Because since gold reached new nominal all-time highs, we have seen some of the big producers rise and kind of remain at somewhat elevated levels, your Barricks, your Newmonts, your Agnico Eagles. The developers, the explorers, many of them have yet to kind of play catch up. So I'm wondering what your thoughts are there. If you think we're going to see higher gold prices up ahead, if you think that's going to translate and trickle down through the miners to the developers, to the juniors, and maybe some thoughts on the silver miners as well, if you could hit us with that.
So I think the mining companies are incredibly cheap in relationship to the precious metal itself. We're talking like all-time lows. So if you were to price that as a ratio, like XAU divided by gold, you're at like all-time lows, going all the way back, 70s, going all the way back there. So the setup is there for the gold and silver mining companies to drastically outperform the miners. And we just recently broke a big downtrend line on that as well. When gold goes up, it generally goes up during a certain portion of the business cycle. It usually goes up when the yield curve inverts, it's inverted, and then when it uninverts, that is when gold takes off. That's when the quote slowdown comes. So it basically follows the unemployment rate. So if you were to pull up a chart that looks at the unemployment rate and it starts to come on up, that's when the yield curve generally uninverts. That's when the Federal Reserve lowers rate, and that's when gold starts to take off. Gold generally front runs the uninversion of that curve. It front runs the unemployment rate, and we've already seen gold take off and break to new all-time highs. So I think everything's in motion already. We've broken, into new all-time highs. I think the gold and silver mining companies, if you look at their technical chart patterns, they're putting in double bottoms and breaking out of those bottoming patterns. So I think they are very well positioned for a big move to the upside for a lot of the mining companies. I also think what's great about the mining companies is that everyone hates them. Even people who are in the commodity space, they still hate the miners. Like everyone hates the miners. So even if I have doubts myself, because we're looking at the profitability and the ability for the mining companies to convert, that mining of gold or silver, whatever it is, to cash, I still have to look at myself and be like, you know what? I got to have some allocation here. It's just too dang cheap. The symmetry's too big. And we're perfectly aligned in when gold and silver take off. And a lot of the times you can use that to balance the portfolio, because when the uninversion of the yield curve occurs, That's generally when you do get a recession or a slowdown in the market. The question that I have is, because I know the Federal Reserve's in there monkeying with everything. It's like, did we already go through that slowdown and they've been selling shorter end, bonds to keep the yield curve inverted? I know they're doing all sorts of manipulation there. But do we still have a slowdown that's coming ahead of us, or is it already behind us? That I do not know. But I do know that people are positioning in gold, they're positioning in silver. We've broken big pattern on those. I would be incredibly bullish on the physical metals and on the mining companies because of how cheap they are. So it's in cycle. The technicals look good, and everything kind of across the board, I would say, is positive for the sector. I would take a chance on it, even those that are in disbelief that the companies can or cannot make money. I would still go into it if it were me. But that's my opinion there.
And Ferg, do you invest at all in gold and silver miners? Are you watching the space? And what's your thoughts on the metals themselves?
Yes, I came around to the gold trade. I, for a long while, thought that there was no need to almost be other than physical for just protecting purchasing power. But I've come around to the idea that, particularly with what we're seeing from the East, that we're in the process of having the paper gold markets have taken out. And so once I kind of came to that conclusion, I still went throughout the mining space and was like hunting for a decent call option on gold. And so that was just looking for like the highest cost gold producer that was having its production given no value. And so that was how I decided to express my gold view, was just getting a big call option. Granted, it's not very big. I don't actually have, I think my total gold exposure in my portfolio is like 3%. And then I now own a little bit of physical, but that's pretty small. So it's not a large exposure for me, but I definitely did want to have some exposure there because it's fascinating once you dig into it. I sort of recommend everyone should listen to Luke Groman's Gold Thesis, also Lewis Vincent Garve. And it's just the idea that it is likely going to be the new developing market currency moving forward. They'll settle a lot of trade in gold. And so that's going to increase demand for gold moving forward. Is what always kept me out of gold for years was I just viewed it as a political metal. It was never a market that moved based on supply demand, because when demand got too high, it could be fulfilled with just with more paper gold. The derivative side could always was allowed to expand, which stopped real price discovery, and no one was allowed to break that. Even though even a small hedge fund could have broken it, just take out a whole lot of gold futures and cash settle them. A small hedge fund could have caused a COMEX, and because that never happened, it was because we controlled the game. And yeah, we're not going to allow us to happen for political reasons. Gold needs to be kept under control. Well, what we're now seeing is the East is taking that control off them. So whoever controls sort of settlement ultimately controls the paper market, or can do away with the paper market. And I think we've seen constant sort of premium in the Shanghai market. I think the paper market's days numbered, whether it gets taken out by sort of like Luke Groman said, if the Russians were to just state a certain amount of barrels for an ounce of gold and cause a sort of arbitrage run on physical gold in the West, and that could be how it comes to an end. But ultimately, I think gold's going to trade a lot higher, and I want to have some exposure to that. And so that was how I kind of came around to that view that gold could get revalued pretty significantly. When I'm saying significantly, I'm talking sort of 10, even 20,000. And so I want to have a big call option on that within the portfolio. And so that's where I ended up on the trade. And I couldn't bring myself to buy like gold juniors and gold developers. It was, I had to do it in a particular way that it was a company that produces something else and it just had a really hefty gold production that it was getting no value for. So I wanted to go in that way. And I couldn't really find the asymmetry going further up, looking at sort of exchanges and other ways to play it didn't really interest me.
And when it comes to both your portfolios, are the majority of your portfolios in commodities? How do you weather the volatility mentally? Because very volatile sectors. And what areas outside of the commodity space do you have allocation to that maybe you think more investors should be paying attention to? Andy, I'll start with you on this one.
Yeah, the majority of my holdings are in commodities or precious metals. So that's kind of where I'm at. And the reason I'm majority in that is because that's where the value is at in the market right now, in my opinion. So my portfolio is just a reflection of where I think the value is located and where I think the cycle is going to turn into. So I'm kind of just front running money flows in the market of where they're at and where they will be in the future. Currently, my opinion, they're at technology, and in that sector, I think we're in a tech bubble. Eventually, that will go down and bust, probably driven by inflation and interest rates, in a slowdown with interest rates being held too high, and then money's going to rotate into the assets, hopefully that I'm in. that's that's the goal at least. And it'll be caused by the rates and the dollar dropping and all that stuff. So my allocation is incredibly high to commodities. There's a couple sectors, outside of commodities that I would look at. Emerging markets are one spot, and really the theme of it all is that the dollar is going to get weak. So that's basically the theme of my portfolio if you were to look at it. I balanced the portfolio because you were talking about volatility and the emotional pain or the psychological strength that you might need with the volatility of holding a few sectors. I balanced the precious metals with energy, and they kind of balance each other out. They kind of go opposite of each other. So my portfolio has been pretty steady. I'm across about 7 different sectors, like fertilizers, some like steel, energy service, coal. I'm in all kind of across everything, and that diversification kind of balances it out. If you're 100% into one sector, and I do see a lot of people who really overweight a certain sector, like let's say uranium, they've got like 90% plus in uranium. I'm like, man, that's going to be one heck of a ride. Specifically with the companies that don't even produce cash, you're taking on a lot of risk there. So mentally, I think you have to just know a lot about each of the sectors. You have to have a strong conviction in the future of what you think is coming, and then you have to take a stance where this will materialize with time. Like it can't be like you can't be wishy-washy. Like you got to be like, this is what I think, and this is what's going to materialize. And I know that I'm buying this at a very cheap price, and that markets take time. They're not going to reprice over a couple of weeks or months, or probably even not even a couple of years. This is probably a decade event where we go from bottom of 2020 probably to a top of 2030-ish, somewhere in that range, would be my guess. And then you have to look at all of the data. Are we underneath the cost curves? Do we have cheap ratios? Do the technicals look good? And then you go through this big list and say, yes, 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 yes. And they're all checking yes. You just stay long and stick with it. The volatility is going to be there no matter what. That's something that you're going to have to learn as an investor to cope with. If you want to be in this game, you have to be a byproduct of the game. You have to develop the skills to partake in the game. You have to figure out ways to control your emotions, to maybe become emotionless in terms of your investing if you can. You'll still feel things when it goes up and down. No one likes a 30 or 40% decline in a portfolio, but you have to take the conviction and say, nope, this is coming. What I focus on is future demand on a lot of stuff, future supply. And then you compare the two, demand and supply, against each other. So the question I ask is, how much electricity demand do I think is going to be coming in the 2030s? I think it's going to be way higher. So then you say, what path do we have to get to that 2030 demand from the supply side? And I look at the supply and I'm like, dude, this is jacked up. Like, I don't think we can do it. Like, I honestly don't think that we have enough power for the demand that we have coming. And I think that the attempts by governments to use renewables to cover this gap and get away from fossil fuels will essentially fail. I don't think we've got the mineral supply to basically fulfill renewables. So if renewables are a false option, and I think a lot of people in the tech industries are saying the renewables, and I'm like, okay, well, that's not really an option in my opinion. Then you look at uranium. Total nuclear fan. I think nuclear is going to be huge in the future. But then you look and you say, okay, what about the next 10 years? I don't think there's going to be much nuclear in terms of uranium supply in the next 10 years. I just think it's going to be shut down. So then I look at and I say, okay, there's not much uranium supply coming and the price will go ballistic. I just don't see who's going to make the money off of it outside of the physical, metal of it. So then I say, okay, well, where's all the demand going to go? Well, I think natural gas is going to be absolutely gigantic. We're building LNG terminals all over the place. I think natural gas is going to be huge. I think coal is going to be huge because when people get in a pinch, they're going to panic. And if they're going to panic, what are they going to do? They're going to turn on coal. They're going to go back to coal. They're going to go back to what works and what is reliable. So then when I look out in the future, and then I look at what's happening today, do I see evidence that we are on the path of what I think is coming in the future? Are we doing those things in the short term? The answer is yes. When renewables fail, what did Germany do? They flip back on coal power plants. What are India and China doing? Are they putting in renewables? Yeah, they're putting in renewables, but at the same time, they're just putting in gobloads of natural gas and coal. And it's like, okay, how do we get off of this path? Like, what will prevent people from adopting or using more natural gas and more coal? I don't see any answer to that. Like, there's nothing that's going to stop this big move within the next, I'd say, 10 years. And everyone is so short-sighted. And I think it will just continue out in the future because no one's going to take the stance like, you know what, 10 years from now, we need to build massive nuclear and just throw it all in there. Or maybe the next nuclear is like thorium reactors or whatever's next. I just don't see that being developed within the next years. So I've got all these options that I can buy today that can cash flow. They're already cash flowing. They cash flow more into the future and grow production. I can buy these things for a super cheap price. And I just look at that and I say, I got to stay with this trade, whether it's the exploration production companies or in the energy service world, because that's what's going to materialize all that increased volume and flow of nat gas and whatever else, oil. So I think there's a big disconnect between what the technology people think is coming and what people kind of have for a given. Like, they just think we're going to go to electric vehicles and that's just for sure in the bag. That's what we're doing. I don't think the future is going to be like that. I think it's going to be the exact opposite. I think it's going to be more of the same. I think we're going to go to hybrid vehicles. I think we're going to have mineral constraints. I don't think we can just build out this infrastructure as easily and as quickly as maybe what a lot of people think. And those barriers to entry, that moat around it is what I'll call it. It's almost a moat around fossil fuels. And the adoption of some of these other renewables and electric vehicles is the mineral constraints. And then when you look out in the future, and this is what gives me conviction, is everything in this world that is a metal that basically gets dug out of the ground is a derivative of energy. So that's all future energy use. So I look out in the future and I say, okay, copper supply is going to go short and prices go up. That will be a signal for the markets to produce more copper. But really, it's not, the copper companies may not even make the money. It might be all energy service companies and energy, because copper is going to turn around and say, we need more mines. There are less large mines in this world. They're all small. They're all broken up throughout the world, which means we get a lot more haulers of this, the big trucks to haul this equipment with. We need all these other materials to basically build these mines, get them all with the equipment there. That's all energy. It's all energy. So everything in the future, which is getting harder and harder to get, more sparse and spread out throughout the world, with lower ore grades, exponentially increasing energy consumption. I don't see how energy doesn't get used in just massive quantities over the next 10 or 20 years. And if we try to go to the renewable world or this electric world, we have to burn a crap ton of oil, nat gas, and oil or coal to get there. I mean, just a whole bunch. In that interim, I mean, just as I can keep going, in the interim of us burning all of this energy and the prices probably skyrocketing and the dollar dropping, we look over at our currencies and bond markets around the world. And I look at the bond markets and I'm like, okay, those are just a derivative of energy. So when you look at the bond markets, it's a future claim on some other final payment. Every final payment is generally a commodity or a final product made from a commodity. So when I look at this and I say, okay, how hard is it to make final products and or get commodities out of the ground? It gets harder and harder with time because of reducing, declining ore grades and all these smaller deposits spread out throughout the world that needs equipment and all these things. And CapEx is going to go through the roof because now you can't distribute it amongst these gigantic deposits in one area. So costs are going to balloon on the material side, I think. And if costs balloon and we've got all these debt problems in the world, so debt is credit creation and then no GDP because you have all of these constraints to grow GDP that we didn't have 40, 50 years ago. I think there's going to be a big squeeze in not only energy, but also in bond markets and currencies, which scares me into precious metals. So if you look at it, energy and precious metals are the two big drivers in my portfolio, given that huge kind of outlook or paradigm that I have on the world over the next 20, 30 years. So that's kind of where I look at it. And I know a lot of people talk about copper and the price of copper going up. And I have ways of playing that. But the question I have is who ultimately makes the money or who ultimately has their margins increase in this market? I think the margins are going to increase the greatest in energy companies and energy service companies. And then if there's a scare in the currency, you could see gold and silver and platinum and palladium and all those rocket, and the mining companies could do it too, depending on the conditions that we have at that time. So that's what gives me the conviction. That's kind of my view of what's coming out in the future. And a lot of the pressures in the system will build in energy. It'll build in metals, it'll then build in energy, and then it will build in currencies and bond markets. Ultimately, that's like the ultimate outlook that I have for myself, and that gives me conviction.
Yeah, I love it. So many great points there. Ferg, your thoughts anywhere outside the commodities space you're looking? Are you also mostly commodities focused at this point in time? And how do you weather the storm that is the volatility of these markets?
Yes, I always have my eye outside commodities. I worked in property for a number of years in Australia, so I always like to keep an eye on that. I always like the idea of going back into bricks and mortar, but generally I think it's been financialized. It's so leveraged. I don't see the value there. So answering your question, pretty much all my net worth is in commodities in one way or another, whether it's coal companies, whether it's oil service, whether it's uranium, whether it's PGMs, whether it's tin. The only position I have that could be deemed outside commodities, I bought a bull call on UBS when it bought Credit Suisse. Like, I still keep an eye on something that I think is a nice setup. I am trying to add like another angle. I'm writing a piece at the moment, scouring around the world, looking at trying to pick up developing markets, farmland, trying to find the cheapest EV per hectare I can find. And that could be somewhere where I'd look to like kind of roll some possibly uranium profits and build up, because I just see that being really uncorrelated. And there's some places you can get it under $1,000 a hectare per EV per hectare, whereas US it's between 10 and 16,000 depending what you want to use. You can just get it dirt cheap. So I like that. I like that angle and want to continue to sort of diversify across some spaces moving forward, because I've probably been a bit concentrated by letting some winners run. How I deal with volatility, I've always kind of seen volatility as just as an opportunity. If you've done the work and kind of understand where the sector's going, it's you're going to have a hellishly volatile ride. And the more a position works, the more volatility account can experience. One of the articles that people are probably sick of me recommending, but it's this one by Alpha Architect, and he ran this study where he made he made a fund manager god, and he said if he could look forward 5 years and could pick the 10 best performing stocks, I think it was 10, maybe it was more, in the whole market, how do you think he would do as an active fund manager? And when he ran the volatility that God would run his fund, he would get fired as an active fund manager. And that always stuck with me, that like even if you had perfect foresight, you'd still run such stomach churning volatility that your investors wouldn't be able to handle it. And so I often quote Bill Miller on it, that like volatility is a price you pay for outperformance ultimately, and there's no way around it. I see people trying to be too smart with it, often people trying to hedge their portfolios or carry large amounts of cash, and the idea that they'll be able to buy at the perfect time. I feel like, well, where it is possible, often you've just got to ride the volatility and know what you own and why you own it. Just have a very clear idea of what you own, and then use position sizing to protect. So I'm a big advocate for really considering how you position size. So position sizing to not only protect the downside, like you can go too small, like sort of the 1% idea is fine, but then it's really not going to move the needle. If you like nail a 10 bagger, then that's only 10% on your account. So you've protected your downside, but you've also trimmed the upside. So I always land at about the 2-3%. So if I hit a 10 bagger with a 3% position, I've added nearly a third to my account. That's starting to move the needle. So I usually start with 2-3%. If I keep researching the sector and really love what I see and maybe get a drawdown, then I can take it up to 5. And that's where I usually max out, is 5. And then if I really nail the trade on a 5% position, then yeah, that can really drive performance. And so I think not enough people really give a lot of thought to position sizing and then exiting well, which is another whole art in itself.
Fantastic. I mean, I feel like there's a whole other can of worms we could open with so many things we've discussed today. You just talked about exiting positions. That's something else people have a lot of trouble with. So many other commodities. Andy, I love you mentioning fertilizers there. That's a very interesting sector that is very unloved. You can't even find anybody talking about it on YouTube, on Twitter, anywhere. And that sector is very beaten down right now with great fundamentals moving forward. However, we have run out of time for today. We definitely need to do a part 2. Before I do let you both go, Ferg, tell us about your Substack, what it is you do there, where people can find it.
Thanks. So, I just write all my ideas with what I'm considering buying or selling, or what I'm digging into. So yeah, really where I do all my work. I don't really spend any time on Twitter anymore. I just, or whatever it's called, X now. Yeah, I just found it too toxic. So yeah, Substack. I send out one weekly free email, and that's where I pretty much just talk about what I'm doing with my portfolio.
Great. Well, I'll put a link to the Substack in the description below. I am a free subscriber. It's definitely worth at least taking that first step. as well. A ton of great info in your weekly emails. Andy, talk to us about the Finding Value Finance YouTube channel as well as your website.
I've got the YouTube channel, which I do kind of daily technical analysis updates that a lot of the subscribers wanted me to do. I also have a website. That's where I also share what I'm doing with this commodity bull market that's coming. You can see my portfolio. You can see what I'm buying real time. And I'm also creating a portfolio in real time so you guys can see what I'm buying, what the portfolio looks like, and then my returns as well. So pretty much an open book for that. I do a lot of trainings on technical analysis, on ratios. We got question and answer sessions that we do on the weekends. So you can ask me questions directly if you have any questions. So that's what we have there on the website, which is, finding-value.com.
Great. I'll put a link in the description below as well to your YouTube channel and the website. Gentlemen, it's been an honor. Thank you both for coming on the show.
Thank you so much for having me, Jesse.
Yeah, thanks for having me, Jesse. Appreciate it.